My name again is Robert Leininger, and I am one of the portfolio managers on the value portfolio. And with me again is my colleague Rocco. I will speak first about the U.S. value product that we offer. And then after I finish speaking, Rocco will talk about the merger arbitrage strategy. And then there will be an opportunity for questions and answers after we both do our presentation on the two respective products. So what I would like to talk about is talk a little bit about the U.S. Economy, the U.S. stock market, valuations, and the investment methodology that we do for you through Crèdit Andorrà. So starting with an overview of the U.S. economy. For a number of years now, since the financial crisis, the U.S. economy has been gradually improving. We're going on a multi-year period now of improvement in the economy on many different fronts. We expect the U.S. economy to continue to improve going forward, which we think is a good backdrop for the U.S. stock market. On all three fronts of unemployment, housing, and GDP, things are improving in the United States of America, and we expect them to continue to improve. Unemployment, as we'll get into a little bit later, has been coming down and is currently about 5% in the United States of America. And the housing market has been coming back also. And again, GDP has been increasing nicely over the last few years. We expect that to continue, not at a fast pace, but at a fairly modest pace. On the consumer side, the U.S. consumer is doing much better these days. Confidence is improving, along with the improving job market and improving credit. And on the corporate side, things have also improved greatly in the United States of America over the last few years. Corporate America has an awful lot of cash sitting on their balance sheet. Confidence is higher, and we think that that will help lead to more M&A activity, which we think will help both the long value portfolio that we run, as well as merger and acquisition activity, which Rocco will talk more about later. And as this as a backdrop, the U.S. dollar has also done well over the last few years, and we think the U.S. dollar will continue to remain strong. So in terms of the investment landscape in the United States of America, this might be hard for some of you in the back to read, but again, in terms of real GDP, last year, 2014, 2.4% of the United States of America, forecasted to finish around 2.3 this year. And expectation is that it will continue at approximately that pace, or 2.5% is a good estimate for next year. So nice growth in terms of real GDP. Also, consumer expenditures increasing at about a 3% rate over the next few years. As I mentioned, housing market continues to improve. New home sales are improving in the United States of America, and housing starts are close to where they were a decade ago or so before the housing problem in the United States of America. Unemployment rate has been coming down meaningfully over the last few years. Last year, the official rate was just over 6%. Now it's just over 5%, and we are expecting it to be just under 5% as we look out next year. So by all these metrics, things have been improving, and we expect to gradually continue to improve in the United States. So what is the Federal Reserve, or the central bank of the United States, probably going to do going forward? They just had their last meeting on September 17th. And during that meeting, they decided to leave short-term interest rates at essentially zero, which is where they've been for years. So there has been free money in the United States of America for many years, and we are at the point where many people think it is time to start increasing it. And there was some debate whether or not they would increase it at this last meeting, or whether it will happen in the next meeting or two. But when they did not increase it, they cited global concerns for not raising interest rates. So although things are going well in the United States of America in terms of corporate profits, in terms of employment, in terms of housing, in terms of fundamentals, there is concern about global growth and slowdown in China and other geopolitical risks, and that was the main reason why they did not raise rates. And if we were to make a guess, we would expect that by the end of the year, they probably will start raising interest rates, but if not by the end of this year, probably early next year. However, when they do start raising rates, we think it will be a very, very slow and gradual process of increasing rates. So looking out a year from now, we would not expect short-term rates to be above 50 basis points in the United States of America. So when rates do come and rise, it will be very, very slow. Just a quick review of the investment philosophy we use at GAMCO. We employ a private market value with a catalyst approach. This is what we have been consistently doing for 38 years in the United States of America. It is a form of value investing that's very similar to the way Warren Buffett invests. You may be familiar with Warren Buffett. He runs Berkshire Hathaway and is a famed value investor. So our investment methodology is very similar to that of Warren Buffett. It is a consistent and repeatable process that we have implemented, again, for 38 years with an excellent long-term track record. We are long-term focused, and we tend to have fairly low turnover in the portfolio. The fund that we manage here with Crèdit Andorrà has been in existence for almost 4 years. Since then, the compounded annual rate of return has been over 10% during that time period. And if you look at our longer-term track record, again, the fund has only been in existence for that short period of time, but it employs the exact same investment philosophy that we have used since the founding of the firm 38 years ago. And our composite performance is an excellent long-term composite. You can see the numbers on the right, and you can see the cumulative impact, but this compounds out to approximately 16% on an annualized basis since the founding of the firm. So an excellent long-term track record. Again, using an investment methodology that we've consistently employed throughout market cycles, both good and bad. And that is what we hope to continue to provide to all of our clients going forward.
And thanks for everyone for coming this evening. My name is Rocco, and for the past 21 years I've been a member of the Gabelli Merger Arbitrage team. And merger arbitrage at Gabelli is really a natural extension of what the firm has been known for. As Bob mentioned, value investing involves buying a stock trading at its discount to its private market value with a catalyst. Many times that catalyst is some kind of transaction or merger. Merger arbitrage investing involves buying the stock of a company after the announcement of a merger transaction. We then earn the difference between where the stock is trading in the market after the announcement and what we'll receive at the time the transaction closes. That difference is called spread, and it's an integral part of how we actually earn a return that is non-market correlated. Now, this is just some disclaimer our lawyers made us put in here, so I'll just go through that quickly. Again, we've been investing in merger arbitrage in a separate product since 1985. Mario Gabelli started the fund back in 1985 as a way to provide diversification for some of our high net worth individuals that were looking for preservation of capital and to grow their wealth over the long term. Again, it's proven to be a great way to provide low risk, non-market correlated absolute returns, as evidenced by our, again, 30-year track record, our low volatility of about 2.5%, and our low beta of about 0.15, which shows that it's truly an absolute return strategy. Now, we have a dedicated team that manages the pool of merger arbitrage assets, about $900 million. Myself, two dedicated analysts who each been at the firm for nearly 12 years, Willis Brucker, Paolo Vicinelli, another junior analyst who's been with us for 4 years, and then again a dedicated trader who's been with the firm for 10 years, Bill Gregorio. But I think even more importantly is, as Bob mentioned, we leverage off of the over 40 research analysts at our firm who cover individual sectors on a global basis. We really think that really gives us a competitive advantage in being able to evaluate these announced merger transactions that are occurring on a global basis. And here's just a picture of all of us together. We also have, we're based in New York. We do have satellite offices in London, Shanghai, and Tokyo, and it does help us coordinate a lot of the research as this product is a global portfolio. Again, as we've been investing in merger arbitrage since 1985, and the way we've been investing in the portfolio in a very conservative manner fit very well with the UCIT guidelines. We maintain a very well-diversified portfolio. We don't use leverage. So in 2011, we launched the Gabelli arbitrage UCITS. Now, it really gave us the opportunity to provide a truly hedge fund strategy and a liquid alternative strategy that has daily liquidity. Now, again, one of the reasons why we're able to provide these positive returns is that the process that we use to evaluate these transactions is a very consistent, repeatable process. Again, it starts with idea generation, which is generally a public announcement that one company is buying another. Research and deal analysis, probably the most important part of that process, and I'll get into more detail in a second. Trading obviously is important, how we structure the trading around a position, how it fits into our portfolio, and then how we reinvest those proceeds once each transaction is completed. Again, research and deal analysis. We first look at the strategic rationale of the deal. Why is this company being acquired? How are these companies better together? Strategic acquisitions is a big focus of our fund. The merger contract analysis is also very important. This is basically an agreement between two parties, and our experience and expertise in evaluating these M&A situations and evaluating these merger contracts plays an important part in evaluating these merger and acquisition situations. Fundamental valuation. Again, this is where our research really comes into play. What is the valuation that a company is being acquired for? Is it possible another buyer can come in? Is that the valuation may be cheaper? So research and fundamental valuation is also very important. And then company and industry contact. Many times through our research focus, we already have an analyst who covers that industry, who is involved with the company already. So getting access to company management, talking to companies, competitors, again, gets us access to information sooner, and it allows us to make a decision much faster. Then we evaluate the risk reward for entering that transaction and determine how we trade the position. Risk management plays an important part in the way we look at the portfolio. The most important way that we look at risk management is basically the way we invest the portfolio itself, the way we invest. Obviously, focusing on strategic transactions is one of the best ways we can look at that companies that are looking to merge for the next 20 years, not for the next couple quarters. We maintain a very well-diversified portfolio, having roughly 60 names. Our position size, we usually limit to no more than 5% of the overall portfolio. We think that maximizes liquidity for us and minimizes any individual event risk if something were to happen to one of the transactions. Our holding period is about 3 months. So again, we think that shorter term holding period mitigates some risk that's inherent in some longer transactions. We don't use leverage. I think that's also a key point, is that in periods of volatility, we're not forced sellers. We're able to actually take advantage at better risk-adjusted rates. And then as far as this is concerned for risk management, the firm has a risk management committee overseen by officers of the company and other portfolio managers that meets weekly, but also monitors the portfolio on a real-time basis for capital at risk, for position size, and for industry concentration as well. Experienced investment team with myself and our dedicated analysts and our trader. I think a tremendous benefit for us to have an experienced team in investing in this strategy. And then, of course, our over 30-year track record of investing in this strategy as well. So with that, I want to say thank you to everybody. Sorry if I went a little long, and I'm going to turn it back over to Sergey. Thank you very much, everyone, for coming. Thank you.